Yeah, now it's
Good afternoon. Hope you and your loved ones are doing fine. The Swiss Indian Chamber of Commerce India is organizing yet another virtual event, and this time we have partnered with Khaitan and Company, and the webinar is on a very interesting subject, namely GST and customs duty, strategic issues and recent developments. The speakers today are subject matter experts, and let me introduce them to you first. We have Sudipta Bhattacharjee, who is a partner indirect tax at Khaitan and Company. Sudipta has been recognized by the business world legal amongst the top 40 of India's lawyers under the age of 40. Congratulations, Sudipta, for that. He's a lawyer with more than 16 years of experience specializing in indirect tax advisory. And he is also specializing in tax controversy management and contract documentation across many sectors. Sudipta has been recognized as highly regarded in indirect tax by the indirect tax by World Tax, the comprehensive guide to world's leading tax firms, and since 2020, and has been repeatedly recognized as an indirect tax leader for India by the International Tax Review since 2017. Sudipta has also authored a treatise on how GST applies vis-a-vis various types of EPC and construction contracts. This was in fact published by Taxman Publications. I will now move to our next speaker, and that is Udayan Choksi, our second speaker, who is also a partner for indirect tax at Khaitan and Company. Udayan Choksi is a senior indirect tax professional and also a practicing counsel. He has been working in the tax domain for close to 20 years and has been recognized in International Tax Review's listing of indirect tax leaders for the past 7 years. Udayan advises on all indirect taxes, including GST, pre-GST, customs and FTP, and trade remedial measures, and also represents clients in tax litigations. Udayan's area of focus is tax optimized supply chains, including valuation aspects across direct and indirect tax regulations. He has also been involved actively in tax policy initiatives and had been part of representations made to the government on various tax matters. Before I welcome the two of you, I would first like to welcome Mr. Bhanu Patel, who is going to give the keynote address today. And Mr. Bhanu Patel, he has been with the industry for over than 40 years in different capacities, and is currently the chairman and managing director of a Swiss company, Oerlikon Textiles in India. And Mr. Bhanu Patel is also the executive member of the West chapter of SICCI. And I would request Mr. Bhanu Patel to now give his opening remarks and valedictory address. Over to you, Bhanu Bhai.
Good afternoon to everybody. And from my side as well, I welcome the expert speakers, all high profile from Khaitan and Company, who is a well-known and reputed firm based, what I know is from Mumbai. And I thank Shiv Prasad to invite them and select today's topic, GST and customs duties, in particular the strategic issues and recent developments, where Khaitan and Company they have the mastery over that, I would say. With my experience in the industry, I consider GST and obviously also customs and customs duties as the most important indirect taxes to worry about. And why I say this is because these are the taxes which are directly, you can say, influencing our profitability. Unlike income tax. Income tax is like, you can say, the very after you make profits and all. As far as these taxes are concerned, it's really making our total costing and the whole viability, feasibility of the business model so important that we need to be continuously monitoring these taxes. And this is what, like you can say, many a times we see that people are more engaged in direct taxes, income tax, how much to pay, this, that. But I think indirect taxes, particularly GST and customs duties, are very, very important to see the real feasibility of our businesses. The proper planning and care can save a lot of money and positively influence our results. This is why these taxes are gaining grounds recently, or rather, you can say custom duty, yes, earlier, but GST in particular now, it's gaining ground among the experts as well as the industries. Furthermore, since the introduction of GST since 2017, it is still, I would say, in an evolving mode, and with frequent changes based on the representations made by the industry body and various other, you can say, the affected bodies. With growing tax collection, the government is also looking for expanding the coverage, while at the same time, the administration issues are still making our lives difficult. We need to continuously monitor this and mitigate the risk what may come up, like because of the changes happening very frequently. One more thing I would like to say, that okay, in spite of knowing very well that GST is, you can say, integration of various taxes, indirect taxes, like service tax, VAT, excise, and other taxes. As a consumer, particularly when I see a bill and see a tax at the rate of 18% of 24%, it's really a pain there. But okay, that's the way it is. But psychologically, definitely, it's giving a big pain to the customers. Okay, as far as the customs duty is concerned, updating ourselves from the trade controls point of view is very important to remain compliant and not be blacklisted anywhere, and save our brands from for any mess up happening at the customs level. That's very important, because any like negative list items you come across, and if you do something, if you mess it up, it can really spoil your brand. Additionally, for MNCs, what I've experienced is that there is always, you can say, a trade-off between the assessments done for customs duty purpose versus like assessment or whatever the valuation for transfer pricings. There is always a trade-off, and there also I see the custom duty focus is very much required, and obviously it has to be seen from the transfer pricing as well. So that becomes an important topic for MNCs who have many intercompany transactions with the parent and the subsidiaries. That's a direct experience what I have seen. What I'll make, these are the just a few comments I thought I'll make as an introductory, so that we see the importance of the topic. And with this, now I think I should hand over to the experts to make their special comments, rather the detailed comments. And with this, I hand over to Sudipta first. Thank you.
Thank you, Mr. Patel, and a very good afternoon to all the attendees. Thank you for joining in. Mitesh, we can go to the next slide. The next one, please. Yeah. So I think we'll start with the very basics of GST. We'll start with what do we learn, what are our key takeaways, what has been our experience in the last 4 years from a policy, GST model, administration, etc. We all know in 2017 we started off with a dual GST. The central government and the state governments pooled in their sovereignty, their legislative powers to arrive at this dual GST construct. It has been hailed as a great experiment of cooperative federalism, aided greatly by the fact that there is a compensation that was promised and that continues to be issued. There have been hiccups in that, but more or less it's flowing in. The cynics say that the real test of cooperative federalism would be once the compensation stops, because that's when the states would be prompted, especially the ones who are under any sort of revenue stress, would be prompted to explore unilateral options. And I think that's when the test of whether GST remains uniform across the country, the credo of one nation, one tax, I think that will be tested. But that's a little way ahead of us, so we don't need to get into that today. In terms of the operationalizing of GST, I think the overarching role all of us would have seen has been played by GST Council vis-a-vis every aspect, policy or procedure. They have been very active. Vigorous discussions have taken place on multiple things, and frequently, they have been responsive to representations, etc. So what does that tell us? What does our experience for the last 4 years tell us in terms of strategic insights for policy representations, for advocacy efforts? Given that it's a dual structure, it's a no-brainer to say that yes, we can approach both central government as well as state governments when we have a particular thing, particular policy that we want to push through. Practically, however, there are very few things which you can actually push through from a state government. At least that has been our experience for, most of the clients that I have dealt with, unless it's an issue that a state government feels very, very, very strongly about. Case in point being extra neutral alcohol. As many of you know, that GST on extra neutral alcohol, which is a very most critical raw material for the alcoholic beverages industry, from which today the states are earning the maximum revenue. The states fought tooth and nail. Multiple rounds of discussions have happened, and effectively today there is a moratorium on levy of GST on extra neutral alcohol. Unless we are talking about that sort of an issue, more or less it is the central government, the CBIC, the TRU, Tax Research Unit forming part of the CBIC. These are the authorities, these are the bodies which drive the discussion. So when we are planning strategically to move, to make representations, to move any particular policy point, we need to calibrate that. There are a few points where going through the state government might make sense, but more often than not, it is the central government, it is the TRU which sort of is the right body, right authority to approach. Because more often than not, they are the ones who will end up making the recommendatory notes, the agenda notes, the background to that, and they play a key role in how the discussion proceeds in a GST Council meeting. The second key piece when it comes to policy advocacy are the courts. Now, it may seem like a bit of a contradiction in terms, because often we see litigation and representation as two sort of fork in the road kind of a scenario. They seem to be mutually exclusive options, but that does not need to be the case. We'll take you through two case studies very briefly, and these are both matters that I have personally fought, one in Madras High Court and one in Delhi High Court. In the first one, it's one of the world's largest e-commerce companies in the passenger transport space. And the issue of the debate was vis-a-vis bike taxes, motorcycle taxis. Is GST at 5% payable on the services of bike passenger transport through bike taxis? Is it not? Our client was paying 5% GST. Many of its competitors were not. The representations were filed with CBIC, but to no avail. Nothing was being heard back from them. So what we did is we filed about 4 or 5 reminders to that representation within a period of 6 to 7 weeks, and then approached Madras High Court. What did we say before Madras High Court? We said that, look, this is the issue. We are not saying that, we are not asking CBIC to hold one way or the other. We are saying you clarify one way or the other, whichever is in your view the right position, you clarify, because if you do not clarify, your failure to clarify is leading to a scenario where there is inequality in tax treatment between people who are similarly situated, people who are doing the exact same business. I do not exaggerate. In the first hearing itself, we got an interim order, ex parte interim order, instructing the CBIC to hear the matter within 5 weeks' time. They did hear us, not only my client, but the entire industry, the key players in the industry, filed a detailed affidavit, not only upholding the tax position that was taken by my client, but also saying that, we will pursue proceedings against people who have not deposited, because it's a very clear case. Tax should have been deposited on this. So the strategic objectives of the client in having a certainty of tax position was achieved. First, we tried the representation route. It took much longer. Court, judicial intervention, judicial review was sought to expedite that process to ensure that CBIC does its job. And this can be replicated in multiple scenarios. The second scenario that I wanted to talk about is what we did for Indian Wind Turbine Manufacturers Association. A similar sort of issue, GST rate vis-a-vis wind turbines. There was a 70-30 valuation rule that was brought in without really consulting people in the wind sector, and yet we were not really getting an audience. And we approached Delhi High Court. Again, I do not exaggerate. it took us 45 seconds of argument to get, from the to get the particular interim order, and before we could have detailed conversations, present our status, present our inputs as an industry before the Delhi High Court. And there would be many more examples. These are some two that I have recently fought in the last 1 year or so. The point that I'm trying to make is, when we are calibrating our strategy vis-a-vis policy of advocacy, policy representation, I think all of these aspects are very critical and we need to keep this in mind. Moving to the next point, in terms of administration, I think no one can deny, all of us know that huge amount of intervention has happened, positive intervention has happened from high courts across the country. Especially on issues where SSEs often found themselves helpless, whether because of technical issues, technical problems, they could not transition credit on time, could not file any return on time, or expiry of e-way bill, what have you. I think a whole assortment of issues have arisen because, at least in the initial years, there were teething troubles with the GSTN. And unfortunately, the department used to be a lot more straight-jacketed in its approach, a lot more literal in its approach, and courts adopted a very relief-giving sort of attitude, not only across the country, multiple high courts across the country. So it's not a region-specific or state-specific trend. While it's a welcome thing, and they did fill in a lot of gap, I think what it has led to, it has dented, or at least in some way reduced, the institutional capacity of our tax bureaucracy to opt for a more friendly, relief-giving, out-of-the-box thinking sort of an approach. As recently as 2 weeks back, one of my clients, on a very procedural non-compliance issue, something that is not even their fault, they had a DRI raid in their office, and the DRI officer kept saying that, and they had opinions from 2 or 3 senior advocates, and it's a very clear position in law. There are many case laws. The DRI, when they saw the opinion, they said that, you know what, if it's so easy, just get an order from High Court. You guys anyway keep going to High Court, otherwise I'm arresting you. So that's the level of conversation, and this might be an extreme sort of an example, but I'm saying that this sort of typifies the typical approach that one often sees. People are not willing to step out of the sheer letter of law, and I think at some point, and of course this is a larger debate vis-a-vis judicial activism. It's not only in the sphere of tax, it happens in other spheres also, but especially in tax, probably some introspection is required now that we have finished 4 years, moving towards 5 years of GST. This is probably an area of introspection. Another area, sort of connected point is, and this has been, of course, my experience with multiple clients who have branches across the country. They say that, when we interact with central GST officers versus state GST officers, there is a marked distinction in terms of ability to comprehend nuances of transactions, ability to comprehend, principles of law underlying various tax laws, especially when it comes to service transactions. And the reason is not difficult to fathom, because most of the officers at the state level were sales tax or VAT officers. So when it comes to sale of goods, I think they have a lot more depth, they have a lot more expertise. But when it comes to service, and if you remember that a lot of action in India, a lot of development, a lot of innovation in India is happening in the service sector. So unless our tax officers are able to understand, are well placed to understand, we are likely to have unnecessary disputes. And I think this capacity building need for training at a state level is also another thing, because I often hear clients getting really frustrated that it's so difficult to make them understand even the basic things that a service tax officer would understand in a jiffy. We have to start from 2009, how service tax came and how the entire thing developed, etc. So I think this is one point I wanted to make vis-a-vis from the administration perspective. Can we move to the next slide, Nitesh? Yeah, advanced ruling is, I think, another topic. I would it's probably beaten to death, but I think few points need to be made. It has got a bad rep, justifiably, as authority for adverse rulings. It's called authority for adverse rulings because of the very clear, determinable pro-revenue bias. Because obviously it's being manned by officers, senior tax officers from the department. But for all the bad rep it gets, it's important to highlight that it has its uses. The first use, of course, is expedited route to a high court. Often the way legal on a issue legal interpretation, a slightly deep legal interpretation is required. Unfortunately, we get it only at a high court level, where people who are judicially trained are looking at a particular scenario. In order to reach high court, if you go through the statutory route of appeals, etc., it may take 6 to 7 years, maybe more. But advanced ruling can take us there in maybe 1.5 years time. Because once you have lost at double AR, I mean the advanced ruling, and then the triple AR, there is no further appeal. You have to go on a writ to high court, and it has multiple people have done that. Many writs have been filed against advanced ruling authorities. So this is one sort of use that one can plan for advanced ruling authorities if we are looking for long-term certainty of tax position. Second, of course, in a commercial contract, where supplier and recipient have different views on a particular exemption or a particular tax rate that is applicable, I think this can be one of the ways to do a tiebreaker. I have just recently done for a company whose business is converting or regasifying liquid natural gas. So liquefied natural gas comes in a ship. My client basically converts that into gas again, and through a pipeline ships it to its clients. Now, whether that is eligible for a 12% rate as a job work, or should we be still chargeable at 18% those services, that has been a debate, and we have gone back and forth on that. As a tiebreaker, an advanced ruling was obtained. Advanced ruling authority said yes, 12% is available, and now we have made some movement on that debate. So this is a second sort of use case scenario for advanced ruling. And third, of course, is we now have, I think, some 1700 or 1800 advanced rulings in the last 4 years. It's a massive question bank. If nothing else, we now know where the attack is going to come from in an audit. We know what the department is thinking, and it gives us an ability, if we are able to leverage this database, it gives us an ability to be better prepared for GST audits, better prepared on the questions that might come up, to predict the line of attack. Contrary advanced rulings have been a major challenge, has been a major talking point. There has been discussions about a national authority, etc. Unfortunately, we have not really moved in that direction. This, coupled with the fact that we don't even have GST appellate tribunals, while appellate tribunals have nothing to do with advanced rulings per se, I'm just saying that I think these have been major misses in terms of GST administration in the last 4 years. Mitesh, next slide, please. Right. Let's talk about the next big thing in GST, investigations, because a lot of investigations are happening. Many of you are struggling often maybe with investigations. I typically take a 2-hour session on just these 4 points. So obviously we're not going to cover all of this in this time slot. What we will cover and focus on are arrests during investigations. Pending the completion of assessment, also arrest power is there under GST. It's a fairly draconian power, and unfortunately it is being misused left, right, and center as a coercive measure. So let's spend a little time understanding where these power of arrest is being triggered. The section relevant section is section 69, which reads when the commissioner has reasons to believe that a person has committed any offense specified in, and I'll take you through what are the sort of key triggers, may by order authorize any officer of central tax to arrest such person. So reason to believe, when a commissioner has a reason to believe that a person has committed the specified triggers, specified activities, then arrest can be authorized even if assessment has not been completed. And that part is very, very critical to remember. Of course, there are details like whether if the alleged amount of evasion is more than 5 crores, it becomes cognizable and non-bailable. We'll not get into those technicalities in the interest of time. Let's spend and focus on the triggers. Here are the triggers. First one is commits or causes to commit and retain the benefit arising out of supply of goods or services without invoice. So supply of goods or service without invoice. The second trigger is a mirror of this, which is issuance of invoice without any supply. So On first thoughts, it would seem like these are very serious offenses, and they justifiably definitely are very serious offenses. But there are scenarios where in innocuous cases for compliant SSEs also these might get triggered, and I'll tell you how. Let's take the example of a company which has multiple GST registered branches, say one in Delhi or one in Bombay, and it's Bombay where the CFO of the company is sitting and who is managing the entire financial affairs of that company. And if Bombay office is not raising a support services invoice, factoring in the CFO's role, the services, so-called services of the CFO, it's not raising a support services invoice on the other locations, the revenue authorities can trigger the first one, which is supply of goods or services without invoice. And God forbid if it's a company whose output GST is exempt, maybe it's a hospital chain, maybe it's in the oil and gas sector, because in that case the intent to evade tax, it becomes that much more stickier as an allegation. If there is a free flow of credit, one can argue that it's revenue neutral anyway. If I charged, it will be eligible for credit, etc. But if the output is exempt, this can be a real risk. And let's look at the mirror scenario, which is in fact being invoked a lot more frequently. This is when often companies are as a part of cash flow management strategies for liquidation. There may be a particular registration where there is a accumulation of GST credit and they have nothing to use it against. And in order to liquidate that, there are multiple strategies. One of them is to raise cross-charge invoice from that location to another location, which might have ability to absorb that sort of a credit. One needs to do that very, very, very carefully, because if there is a challenge to the substance of that cross-charge invoice, then this is the second trigger that can become relevant, which is issuance of an invoice, of a tax invoice without any underlying supply. The department, and these are live cases, I'm not sort of hypothesizing here, these are live scenarios wherein audit department is saying that you have taken a position that location X has provided support services worth 50 crores in the last 2 years to location Y. How is location X capable of providing services? You have only 2 people sitting here and 1 computer, and you have only a small office or something like that. So basically the substance of the transaction is being challenged. They are saying, what exactly is the service you're providing? Show me, tell me, show me emails. If you're saying everything happened on phone calls, then show me call logs. You have to prove that genuinely some service was being provided, and failing which we will arrest you under this particular trigger. So this is the second sort of trigger to remember. Third is a connected point, which is if you avail input credit using any of the, using the invoice that we just discussed above, invoice which has no underlying supply. So what they're doing is they're capturing both ends. The second trigger captures the supplier. The third trigger captures the recipient. So if I am in my example location Y, they can come and tell me that you knowingly relied upon a fake invoice with no underlying supply, so you are also culpable or liable for arrest. And I'll give you a live case study for which we had to fight really hard recently. This is for a very large e-commerce company who, they need to appoint many manpower. They need a lot of manpower for delivery, for logistics, etc. They have a manpower supply contract. Say, let's call him L1. L1 subcontracts part of that manpower supply to, say, L2. It turns out that in some investigation, it appeared that L2 is not a real entity, it's a fake entity. Even that is questionable. The reason why they reached is because in 2020, in the peak of lockdown, someone did a inspection and there was no one found at the office location. So it was concluded that it's not a real entity. They did not chase L2. They did not chase L1. They did not even cancel their registration. They came straight to my client saying that you have created an elaborate web of sham companies in order to avail credit. You have received credit and availed credit on the basis of fake invoices when no service was actually received, and either you pay up 20 crores of alleged fake credit or we will arrest you. So that's how it happened, and we had to fight tooth and nail in the sessions court to give them pre-arrest protection, because the moment you go to a criminal judge who does not know GST and the government is arguing vociferously that your lordship, there are too many cases of frauds happening, and you do read them in the papers, uh, there is a sort of bias that you have to overcome. In our case, thankfully, we had a lot of checks and balances in place to prove the genuineness of the services. We had video clips, we had biometric records, we had other documentation, Aadhaar card copies, etc., to prove that genuinely. Thankfully, because this was manpower supply, it was easier to prove in that sense, because you have a real human being who sort of comes in and the footprint is there. So this is the third sort of trigger. And fourth is collection of any amount as tax but not depositing it beyond a period of 3 months. This again will seem like a fairly strong sort of or a very serious sort of offense, and which it is. But let's take a scenario where you are entering into a contract, both parties know that this is exempt, there is no GST leviable on this, yet because maybe one has not paid attention, you write in the contract price clause, contract price is ₹100 inclusive of all taxes. GST authorities may tomorrow come to you and say that, why have you said inclusive of all taxes? It means you knew that there is a possibility of tax, and so you have the ₹100 is inclusive of tax, you have collected the tax and not deposited the tax amount with the department. So one needs to be, even for boilerplate clauses like this, one needs to be careful as to what it can trigger. And again, as I keep saying, none of these are theoretical examples. It may seem a little far-fetched, because one may say that commissioner has to have reasons to believe that these offenses are being created. But do you know where else the word reason to believe appears? For blockage of your input credit ledger, and when that has been triggered? For 2A 3B mismatches, when two of my very procedural forms don't match, without even giving me a chance to reconcile, credit ledgers, credit taking ability gets blocked under Rule 86A. That uses almost the very similar language of reason to believe. So if 2A 3B mismatch can lead to reason to believe of ITC fraud, it's not far-fetched to think that all of these scenarios that I enumerated can sort of, one hopes not, but can fructify. So which brings us to the next point. Mitesh, next slide please. How do we protect against it? Of course, we cannot be 100% foolproof, but there are steps that one can take, and these are some of the things that learnings that we have implemented. We need to ask ourselves, we need to check whether a particular client organization has very clearly defined processes or protocols for handling. Let's start with summons, because once you get a summon, that sets into motion a series of events. Is there recording of statement? What is the summon for? What is the line of investigation that is being pursued? We need to have, when I say a protocol, what does it need to cover? Are we training our non-tax teams, especially on the business or ops side, on the tax positions that we are taking on the basis of a certain understanding of our operations? We believe that our tax position is based on, say, a sale of goods. We believe it's a sale of goods. Does my sales head think of this as a sale of goods, or he is thinking of it as a service? It's a very sort of simplistic example, but I think you understand the point I'm trying to make. It's very critical that we share the same understanding of the transaction flow as our business, ops, and sales teams, because often those are the people who will be summoned after the first leg of summons. So typically, when the department wants to go deeper, those are the people who get summoned. So it's important to train them. Need for sensitization of rights and liabilities. There are a lot of case laws, etc., a lot of trainings that can be done, but very, very important for people to know what are the rights and liabilities. How quickly are we debriefing an employee after a summons? If tonight I have, I have sat till 10 in the night and have given my statement, I have answered questions, tomorrow morning there should be a debrief, so that we know exactly the things are fresh in the deposed employee's mind, and we know exactly where it is going, and if there is any need for retraction, if any statement needs further clarification, that can be actioned immediately. Or if we want a copy of what the statement has been made, all of those can be asked for immediately. And of course, last point is reviewing summons from the perspective of challenging in a writ. Typically, a high court will not step in and intervene in a summons stage, because it's still investigation and courts are very, very reluctant to do that. But there are scenarios, maybe 1 in 50, cases where it can happen, we need to be sure that we have explored that particular possibility. Similarly, I mean, a protocol for search and seizure, because often, they can seize your IT assets. How do we ensure business continuity at that stage? Because, a good officer may say that, okay, I will clone your device and give it back to you tomorrow. But if he decides to keep it, frankly, I mean, at least for 7-8 days, there is not much you can do, because he can create multiple excuses to say why I need to have this particular device, etc. And the courts will also be very careful in intervening, because they may feel that we don't want to, overstep ongoing investigation. So do we have business continuity protocol in a search and seizure scenario? And of course, training of employees for how to handle search and seizure. Periodic health checks, like I mentioned, to anticipate areas of disagreement with tax authorities, reviews of interbranch transactions, vendor ecosystem, etc. So these are all things that one needs to be mindful of. Next slide, please. Mitesh, let's go to the next slide. Yeah. I think we have already spent quite a bit of time, and Udayan has a lot to speak, so I'll make this my last slide and hand it over to Udayan. So this is an issue which, I mean, from a Swiss Chamber of Commerce perspective, might be a very pertinent issue, which is taxability of intangible goods. The reason why I say pertinent issue, because just the last week I saw an advance ruling where a Swiss pharma company had sold its trademark to an Indian entity. And obviously the advance ruling was filed to understand the GST treatment. It was struck down for being non-maintainable. We'll not get into that. But the advanced ruling authority seems to have concluded that this kind of a sale qualifies as sale of goods, sale of intangible goods. Even though the trademark is not a tangible thing, it was held to be sale of goods. That raises many interesting questions, because customs duty in India applies only on tangible goods, physical items. There was the WTO moratorium agreed in 1998, which continues, which is for not imposing customs duty on electronic transmissions, while trademark did not necessarily qualify as electronic transmission, but more or less the position has been that there is no customs duty on intangible items import. Does that mean there is no import duty in India for someone who imports an intangible item? If we look at Section 5 of the IGST Act, which is where the levy for interstate imported goods coming from, first proviso of Section 5, it says integrated tax on goods imported shall be levied and collected in accordance with the provisions of Section 3 of Customs Tariff Act. Levied and collected. In my reading, in a plain reading, this is sending the levy to Customs Tariff Act, which triggers only when customs levy, customs duty, basic customs duty becomes applicable. So if there is no customs duty, logically, going by a plain reading of this first proviso, there should be no IGST either on the importer. This, as attractive as that argument is, there is a recent Sestat judgment which seems to counter that. In the case of Interglobe Aviation, the question of law is slightly different, but what it observed is integrated tax is levied under Section 5, but is collected in accordance with the Section 3 of Customs Tariff Act. And on that basis, it held what it held. To my mind, this is, with all due respect to the Honorable Tribunal, this flies in the face of the clear provisions of the statute, which I have accepted in the previous bullet. The section says levied and collected. I don't know how a court can say that no, it is levied under this but collected under that, because I think the provision is quite clear. So clearly this is a debatable subject, and I will not spend too much time on this. But if we are able to reach a no GST conclusion, I think a lot of such transactions, whether it's a sale of trademark or a sale of software, this can be a very attractive planning option. With that, I'll pause and hand over to Udayan, who has many points to cover.
Thank you, Sudipta, and good evening, everyone. Mitesh, next slide, please. So in the second part of today's session, I'm going to touch upon some customs and a large variety of supply chain issues. And Sudipta has gone sort of deep into what the current issues troubling people on GST side are. I'm going to do a quick flyby in terms of the several issues that are both matters of risk and in some cases matters of immediate concern for businesses in India and especially MNCs. Mitesh, can we have the next? No, a couple more after the section divider.
After this.
So I'm going to start, since I'm going to discuss customs and supply chain. Mitesh, next slide, please. I thought I'll start with a quick diagram just to contextualize what we're going to discuss today, which is what does a standard supply chain look like? And then, as we plan our taxes a bit better, what are the issues that can arise and how do these moving parts actually change? So we're really dealing with here an Indian entity and their inputs and outputs, their sets of inputs and outputs. So we started with the supplies that they get from outside India, which will attract basic customs duty plus the social welfare surcharge. That's something we'll come back to because that's become a very troublesome issue. And then on the domestic supplies of both goods and services, you'll have the relevant GST paid S plus C or IGST as the case might be. And then on the output side, there will be a tax if it's a domestic transaction, and then if it's an export transaction, of course, you have the option between paying the tax and not paying the tax. So this is just a very standard sort of lay of the land for an Indian, business. We did have some issues from a customs and supply chain perspective when GST came in 2017, as Sudipta mentioned, and fortunately, fairly early on, some of those key issues were addressed, which was starting with the issue of warehousing transactions and high seas sales in terms of the potential double tax that might have been in terms of the same Section 5 that Sudipta was talking about. Fortunately, then they put that in Schedule 3, and then they said that that's a transaction which doesn't attract tax. Likewise, merchanting transactions, for those of you who follow this sort of business model where you have an Indian presence, but goods move from country A to country B without actually touching India, then those have also been excluded from the ambit of GST. Now, when we look at the larger context of supply chain, I'd leave you with the proposition that there are three things to really think about. The first is the compliance aspect of it. As Bhanubai mentioned, there's the transfer pricing piece, which actually sits on top of the GST and customs piece. So you have two sort of opposing taxes which are pulling in different directions, and you have to find your way in terms of complying with both of those. The second, which typically is a focus area for everyone, which is minimizing tax cost itself. And that's what you see in the supply chain here. How do we actually make sure that prices can be kept right by making sure that there's no taxes which sit into your cost unnecessarily. And the third, and which is, I think, a point which is coming now into sharper focus, which is that how do you plan your supply chain from an international, trade remedies point of view, in the sense that do you need to tweak prices up and down, or do you need to monitor prices to make sure that what you're doing on today's profit maximization shouldn't actually result in a situation where you're facing an anti-dumping duty tomorrow. So, that's a third piece. So actually supply chain, therefore, to my mind, has these three pieces: the compliance, the tax minimization, and also the sort of looking forward in an international context. Mitesh, next slide, please. So with that, we look at two key issues which are on the customs side. And while the issues are per se sort of settled and simple, I think it's in terms of their practical implementation that we do face issues, and clients do reach out on those points. So let's start first with customs valuation with related parties. We know that there's transfer pricing provisions which dictate how those goods need to be valued. We've, right from 1988, had the customs valuation rule, which then rolled up in the 2007 rules in line with the movements at the WCO. And then we had Circular 5 of 2016. That's been the last actual instruction in terms of what process needs to be followed for related party imports. So we have the filing of annexures, and that part is fairly straightforward. But we still have instances from time to time. So mind you, I think two important things happened after 2016. We stopped having this renewal of SVB orders every 3 years, which was quite a pain point for several importers, especially because the periodicity of that 3 years tended to take a couple of years for those renewals to come through, and then very often you got dragged back into provisional assessment and payment of RD. So fortunately, that's been simplified. Having said which, there is much more focus being looked at from this transfer pricing overlay with customs valuation, and we do find increasing cases of transaction values getting rejected. Now, as you know, there is the NIDB, the National Information Database, which is available to all customs officers at the click of a button, and they know for the HSN that you're importing under what prices have been charged for the last 3 years or longer. And that's something which is always going to be in their mind when they are assessing you. And therefore, we've had sort of cases where, the second point, you see that the transaction value is not to be rejected merely because there's been other imports at higher prices, but we are facing situations of that. And those are situations where, which underscore the need for proper documentation and proper processes to make sure that the prices that related parties are charging is correct. The second is the additions under Rule 10 and some case law evolution on what sort of things can get added to your assessable value for customs. Now, as you know, Rule 10 has this condition of sale criterion, which is that it's those amounts which haven't formed part of the value of goods which need to be added back. And we had the Reebok case a couple of years back, which said that advertising costs borne by the Indian importer, because they were a condition of sale and effectively was seen as a cost of the Indian entity, of the foreign entity being borne by the Indian entity, and asked for that addition to be made under Rule 10. So, it's very important to make sure that the intercompany contracts that get put into place actually address some of these finer nuances. Sudipta made the point about, boilerplate clauses actually coming back and biting you. And I think in intercompany agreements, that also tends to be the case. Intercompany is, of course, in the same group, and therefore, sometimes we don't need to sort of specify all of those points in that much detail as you would with perhaps a third party. But we have faced several instances where, there's an ambiguity on treatment. Take the same IP point that Sudipta mentioned also in terms of, let's say you're importing branded goods. Does your supply agreement under which you're purchasing those goods talk about your right to resell under that brand? And then, sometimes wording in relation to that resale right can also give rise to customs complications. In fact, as we'll discuss a little later, they can also give rise now to GST complications in the context of Schedule 1, transactions without consideration. The second is, and again, going back to the point Bhanubai mentioned about, transfer pricing and customs pulling in different directions. We had the OEC guidance, which came out a couple of months back on amendments that companies, multinationals might make in terms of their transfer pricing setup in the context of COVID. So profitability has been hit for several sectors, and therefore, there have been, it was an issue big enough for the OECD to actually issue a guidance on it. It's a 30-page guidance which talks about what these companies need to do. Now, if you look at that situation through an indirect tax lens, I think we have to appreciate that there's three sets of parties which will come through. There'll be the gainers, the losers, and the neutral in terms of which sector you're in. And obviously, the focus is on those who have lost out in the COVID as a result of COVID. I think there's two things that therefore one needs to look at from the customs angle here, which is that if there's going to be a change in your intercompany price, and that's going to be justified by what you've done for transfer pricing reasons, then that documentation needs to come through. It's good to have that on record. I think from a comparator's point of view, the expectation would be that similarly placed companies would also have sort of similar price reductions. At least that's what the OECD guidance talks about, and I think it would be a sort of fair assumption to make, even though customs has generally not been, or the WCO, not just Indian customs, but even the WCO has not been that forthcoming in terms of issuing clarifications of this type. But certainly this is, one sort of issue to keep in mind. I think that issue only gets more complicated if you actually have a change in contractual arrangements which have come through because of how you reworked your transfer pricing. So that's, a couple of points to mention on the S3B side. Nitesh, next slide, please. The second bit that I wanted to talk to you about on customs is on FTAs. Now, as you know, under Article 24 of GATT, WTO members are allowed to enter into free trade and regional trade agreements. India has been quite active in that space. In fact, for the longest time, we've been negotiating a treaty with the EU, though that's yet to see the light of day, as also with Australia, and we hear there's going to be one with the UK as well. Now, a key aspect of India's FTAs or any FTAs is this requirement of originating status for goods which are coming in at this preferential rate of duty. And the basic proposition there is that if you want the goods to come in at this concession rate of duty, then those goods should qualify. They should be qualifying goods under the origination criteria. So each of our agreements actually has a separate set of rules in terms of what the originating criteria are and how they need to be met. So in terms of if you wholly originate or if you don't wholly originate, then what's the test that you need to apply, which could be a requirement of change in a tariff level, or it could be specific to the product that you have, or of course, it would be the criterion of value addition. So how much value addition is actually happening in the exporting country. So for any of you who are actually using the benefits of these FTAs, this is something which you need to keep in mind. Now, the responsibility in terms of whether or not an FTA benefit is being correctly taken, that responsibility is being shifted in some ways from customs in that sense to the importer, and that was under the Carota rules which came in towards the end of last year. They're fairly complicated rules, and in fact, we've had some discussions in the office in terms of the extent to which these rules can actually be challenged in terms of what India's obligations are under its treaties with its FTA countries. And does this actually put too onerous a burden on the importers to have information, keep information, and file information that otherwise they might not be privy to? But very briefly, there are additional declarations that importers need to make at the time of the import itself, stating that they are seeking the FTA benefit, and there are certain other declarations that need to be on the bill of entry. And more importantly, as you see in Circular 38, which we refer to on the screen, there's a fairly detailed set of data points that the importer is required to actually maintain in terms of who the exporter is. Now, this might be well and okay to do if it's a related party import, but keep in mind that several of these could be actually parties who are, third parties, and you're asking for data which, to a certain extent, would actually be, confidential and not readily shared. So the circular does put a scheme together saying that your first onus, and it's a fairly detailed table, your first onus is to actually have 10 or 12 data points, including how much of the good is manufactured in the origin country, what the process of manufacture is, where each of the raw materials has come from, and what the value addition is. Now, as you would imagine, that's a fairly sort of tough ask, especially if the party is unrelated. The process then says that, if you're unable to justify to customs that you actually qualify for the FTA duly, that could be suspended. In some cases, it can be scrapped altogether, but otherwise customs will reach out to the designated authority in the exporting country. So it's a whole new system which has been put together. I think that the two key things to note here is the increased scrutiny around FTAs, because as you would have seen in the circular itself, it talked about perceived misuse by the government in terms of FTA benefits. And therefore, there is this added responsibility that every importer who's making such imports needs to take. The second is the issue of properly worded contract. So if you're actually making an import from a third party, and you're going to rely as part of your commercial negotiation with him that the price is going to be factoring in a duty concession, and that's a certificate of origin which he's going to source for you, then given this responsibility which falls on you, which is coupled with the responsibility that he had to give you the CO in the first place, that might be something to now put into contractual wording, because if tomorrow you're faced in the situation of a certificate of origin which gets questioned, then you're actually in a position where you're dealing with a piece of paper which doesn't offer you too much protection. Next slide, please, Mitesh. So with that, customs, I'm just going to quickly touch upon a couple of issues on the foreign trade policy. Again, like I said, I'm putting this all in the context of the supply chain diagram that I drew at the start. And now, let's say for an Indian exporter or any of MNC who have these presences in India, the earning of these reward schemes was quite often a part of their pricing model. So you priced what you're going to sell at based on the assumption that there's going to be an MEIS that you will get at the end of it, or if it's a service export, then an SEIS. Now, as you know, these schemes were questioned before the WTO, and these schemes are now sort of going to end, or well, they have ended in that sense. The MEIS scheme ended last year. The SEIS scheme, one doesn't know the decisions yet to be taken on it, but I just wanted to draw everyone's attention to 2 points. One is in terms of the deadline, and this is a final deadline. There's going to be no further late cut concession. So 31st December 2021 is the deadline both for MEIS and SEIS scripts for the time periods which you see on the screen. There's a potential issue for challenge here, which is the caps that they've put in: 2 crores per IEC for the MEIS and 5 crores per IEC for the SEIS. Now, these are conditions which came later on, or the caps which came later on. And therefore, I think there's a case to make in terms of these being arbitrary, as well as, you know, to what extent they are violative of estoppel and legitimate expectation. So, two takeaways here, one in terms of the timeline, and if actually the value, the amount of, you know, benefit that you would have got under this scheme is an issue, then that's perhaps something that you might want to litigate about. Next slide, please. The other is SWS, the social welfare surcharge that I mentioned in the first slide. That's the 10% surcharge that we pay as a form of customs duty. Now, a circular was issued last year in the context of the payment of duty credit scrips, payment of SWS to duty credit scrips. What that circular did was relied on Unicorn Industries, of the decision of the Supreme Court, where it was held by the Supreme Court that unless there was a specific exemption for the add-on duties, the surcharge duties, then the exemption won't automatically apply to the surcharges just because the basic duties are exempt. And therefore, this circular has put a clarification in place that SWS is required to be paid in cash. So for those of you who are using these scripts, going forward, this is going to require to be a cash payment. Fortunately, the circular does say that for imports which have already taken place, they are not going to disturb the duties that might have already paid through the script. The other bit of the foreign trade policy deals with the duty exemption and remission schemes, which we're familiar with: advance authorization, DFI, and then the remission schemes in terms of drawback and ROTTEP. Next slide, please. Mitesh. So here is just to put that into the same frame that we had before. If this is and a DTA manufacturer using the advance authorization benefit, you see in green the lower taxes that he would pay because of, you know, the advance authorization benefit that he's taking. So there's no tax of customs of any kind, no BCD, SWS, or IGST. There's no tax if he chooses the invalidation route, even for the indigenous supplies. Services, of course, will continue to be taxed as normal. And then we had the issue of this 9610 condition, which has been litigated a lot. I think several of you might be parties to that litigation, where, you know, there was this issue of the restriction placed on those who had taken the benefit of advance authorization insofar as telling them that the option to pay with payment of tax would not be available to them. So that's, of course, in court at the moment. But this is how the scenario would be for somebody using the advance authorization. Next slide, please. So this issue of the validity, as I said, we have the judgment of the Gujarat High Court, which I think through some sort of oversight or misunderstanding actually made the restriction applicable back from 2017, when in fact it should only apply from 2018. So we are seeing now, you know, several of these cases get settled in terms of, you know, several people have had issues, show cause notices issued by the DRI, which are now starting to get adjudicated. But we wait to hear the final word in terms of what the date should be. But of course, the expectation is that October 18 should be the date from which the 9610 restriction comes into place. Now, on the SWS point, like I mentioned, while you have the script restriction, there's a larger issue which is now coming up in terms of the DRI. I think has issued a few hundred show cause notices in the last month, where they are demanding the social welfare surcharge even for those who have taken the foreign trade policy benefit. So advance authorization, EPCG, as well as the FTA benefit. So even if you've taken a nil BCD based on the FTAs that we were just talking about, all of those on the same principle that SWS is a surcharge, but it's, you know, following the unicorn principle, there are all these notices which have been issued telling people that this is a wrong utilization and that this tax needs to be paid in cash. Now, there has been the other issue in terms of the power of the DRI, the famous Canon judgment in terms of whether the DRI can issue notices or not. So at this point, these have been more in the nature of inquiries. I think eventually the notices will come from the, you know, relevant ranges. But I think that the point I want to leave you all with is that we believe that there is sufficient defense in terms of the manner in which the SWS section was carved out in the 2018 Finance Act to say that it sits on a different footing from EC and SHEC, and therefore to say that on a computation proposition, where the BCD is nil, there should not be a levy of SWS. So without actually sort of interfering with the principle of unicorn, just in terms of the way the rule, the way the section is set out, we believe that, you know, it's not duty levy and collected, and therefore an SWS cannot be calculated on it. Next slide, please. The last bit to talk about on foreign trade policy is in terms of export incentives. I'll just take a quick minute. I know, Mr. Lal, we are a little behind. Can I take another 5-7 minutes? Yeah, okay. So thank you. The ROTTEP scheme, which, you know, was announced with much fanfare, and everyone was waiting with bated breath to see what sort of rates came through, and then it was actually abject disappointment in terms of the 0.3 to 4.3% of FOB, which is actually the rate which has been allowed. So I believe representations have been made and are still being made to actually, you know, recompute those values, especially for certain sectors. It's also unfortunate that the ROTTEP is not available to EOUs, SCZs, and so on. And I was actually looking at some calculations which suggested that this amount of ROTTEP benefit actually seems to disincentivize export vis-a-vis the realization that an Indian manufacturer might actually get. So while we are looking to have a foreign trade policy, and of course our FTP has now got extended to 31st March of next year, while on the one hand we are talking about incentivizing exports, you know, this has been a real dampener in terms of what the calculation is. Next slide, please. I'm just going to touch upon now, before I get to the practical issues, one last bit to touch upon a couple of the trade remedy issues and in terms of what those might do for supply chain. So India, as you know, has always been a fairly active player on the trade remedy side, and of late even more so. Having said which, several of the investigations where positive duties have been actually suggested and recommended by the MOC, we've had the MOF take a call that they don't actually want to levy the duty. So this has been the experience for several industries over the last 3 or 4 months. I'm not sure. I mean, they've of course not given a reason, but I'm guessing perhaps something at the back of the mind might be that if you're looking to make India a manufacturing hub, then you want all raw materials to come in at the lowest possible cost. But when you look at some of the comparable industries or the comparable company sizes in terms of who domestic industry was, it sometimes seems a little arbitrary in terms of, you know, cases in which the recommendation by MOC to impose an anti-dumping duty in some cases and not in some cases, what the reasoning there has been. But anyway, coming back to the larger picture in terms of supply chain management, if you are actually using foreign, you know, exporters and importers, especially if they are unrelated, then it's important to be aligned with them in terms of cooperating as and when investigations of this type arise. Because the consequence of not cooperating is that you get the highest rate. That highest rate can be 10x or even higher than the rate of a participating entity. The second is that companies are now increasingly, especially exporters, looking at periodic reviews to make sure what their domestic selling price is vis-a-vis the price at which they are exporting, to make sure that they are not actually setting themselves up for an anti-dumping duty in future. This is the point I made on the first slide when I said that the third bit of supply chain planning, beyond cost optimization and beyond compliance, is this bit. So for those who actually have a large export footprint, this is increasingly becoming an area of focus. The next bit, which touches upon, you know, customs as well as our regulatory piece, is the use of non-tariff barriers. Now, there's two aspects to this. One is that goods coming into India need to comply with several of these provisions, so there's a compliance aspect to it. But there's also an aspect which Indian importers are using as a sort of non-tariff barrier to protect, in addition to or sometimes instead of a trade barrier which might come under, let's say, a safeguard duty or an anti-dumping duty. So we're seeing increasing incidents of that. More and more goods are coming under quality control orders where there's a BIS standard or something that needs to be met, or a standard that needs to be enhanced in terms of, you know, how it sets out what sort of imports can come in. The last bit is a point of safeguard. So as we have, as I mentioned to you in the context of related party imports, customs is looking very closely at, you know, related party transactions. Within that, we have a development in terms of faceless assessment, which has started in customs like it has for several other taxes. And what faceless assessment for customs means is that you're no longer actually having clearance of your goods or the assessment of the goods at the port of your import. It's actually happening at wherever that centralized hub for those particular sets of goods is. And therefore, you have a much more expert group of people looking at that. And more importantly, you don't actually have the option of a face-to-face conversation in terms of saying, please do a first check of my goods, or please, ask me what your questions are and I will answer them. All of this moving to a virtual model means correspondence happens through the eSanchit platform, and therefore the need for documentation has gone up quite significantly. Linked to that is this bit, as I said, about licenses, saying for a larger number of items in our foreign trade policy, and we've been dealing with this for a couple of clients of late, where policy conditions don't get met. So for example, an item could be restricted for import or is allowed to be imported only through a canalizing agency. And those sort of policy conditions, while don't debar your customs, or are actually creating supply chain disruptions. So that was a quick flyby in terms of some of the customs and trade issues. I'm now just going to touch upon some practical issues just to wind up our session today. Next slide, please, Nitesh. So we turn the focus back to GST and the issue of intermediary services. Now, intermediary, as we know, it was a concept we became familiar with in the context of service tax, where we said that we had somebody akin to an agent whose job was arranging or facilitating a supply. Now, the intermediary services have become important for two reasons. One is the constitutional challenge before the Bombay High Court in terms of the validity of the provision which says that intermediary services should be taxed, based on the place of performance, which means while you could be acting for a foreign party and actually earning foreign exchange, a business model in which you are an Indian entity sitting in India actually makes you liable to that tax because of your place of supplies in India. We haven't heard the last word on that, of course, because we had a difference of opinion between the two judges of the Honorable Bombay High Court, and therefore we have to wait to see what the larger bench on that decides. What this circular has actually done largely is repeat the earlier clarifications that we had in service tax and in the 2018 circular, which says that you need 3 persons, you need 2 supplies, you need the party to be acting as an arranger rather than as a subcontractor. And then the circular goes into certain examples in terms of what is an agent, and those are fairly simple examples that they've taken, versus what is a back office type entity where you're acting for your principal, but you're not actually arranging a service for anyone. And then, of course, the subcontract case. So while the circular actually talks about these 3 sets of activities, the agency, the back office, and the subcontract, it actually hasn't done anything to address the main issue which MNCs were facing in India, which is in terms of the difference between marketing and sales, which are well understood concepts in a transfer pricing context, but something which has been causing some trouble in a GST or even before that in a service tax in an indirect tax context. Now, the issue here is that if I'm actually marketing goods for my foreign principal versus if I'm actually making active sales pitches or being part of negotiation, then does my activity switch over from a marketing activity to a sales activity? And therefore, when do you actually trigger this definition of what is an intermediary? So, and I go back to this point, and I guess from an indirect tax point of view, we can't emphasize it enough, which is that documentation in terms of what you've set out the activities for the entity in India to be are going to be critical. Also, its consonance with how it's being treated for transfer pricing purposes. So we have to wait to see how the intermediary thing finally plays out. But for those of you who are following an intermediary model, do please have a careful look at your contracts to make sure that the role, the activities undertaken in India stop short of triggering what might be seen as a sales activity. There was a second recent circular in terms of export of services of group companies. I'm glad that the circular came because it basically said that subsidiary or parent companies are separate legal entities and therefore they are not, they don't disqualify under condition 5. They don't disqualify an export of service. So while I'm glad that the circular, clarifies this position, in some senses, I'm wondering why that clarification was required, because it was a fairly straightforward proposition, and it's unfortunate if such a clarification was required, because one can only imagine the stress it would have caused those who are in this, both in terms of the fact that they don't get any output tax refund, but also in terms potentially of the fact that they could be faced with an output tax liability. The third recent issue is on classification. We had a couple of rate changes announced last week. I'm just going to talk about two key ones here, the fruit drinks and the renewable energy sector. And two points to make here. One is that it's somewhat disturbing that, 4.5 years into GST, our GST council spent the better part of the whole session actually doing rate tinkering rather than dealing with the sort of issue Sudipta mentioned in terms of an appellate process or in terms of a centralized advanced ruling authority, or more importantly, bringing petroleum products into the ambit of GST, at least starting with natural gas and ETF, which are actually important pieces, revenue consideration aside, given the sectors that they serve. But the two things which really are troublesome in this classification rate change that we had is that there's tremendous ambiguity in terms of both these rate change entries that have come through, both for fruit drinks as well as for the renewable energy sector. Now, they're actually, the odd thing is that you have a GST rate tariff. The GST rate tariff actually aligns itself with the customs tariff. You have notes that tell you that you need to apply the principles of classification of the GST of the customs tariff. And then you actually go and put out a rate schedule or make rate changes which only deal with the 4-digit classification and then don't go down to the 8-digit level and leave you sort of scratching your head in terms of where your product might fall vis-a-vis what it means when the rate entry is only being classified at the 4-digit level. So both of these, I think, are shining examples of that problem. And for those of you who are impacted by these rate changes, do be very, very careful in terms of what position you're taking there. On the renewable energy sector side, in fact, there was one more complication, which was on this issue of the clarification on battery battery and UPS, where they said a battery sold with a UPS should be treated as two separate supplies, and the battery should be charged at 28 and the UPS at 18. And to me, that sort of flies in the face of the proposition of what is a composite supply and all the examples that have been given for composite supply. So I think there's been several of the amendments or the developments on the classification side, on the rate side, really leave one very, very uncomfortable. The last point here is on discount schemes, which is especially post-sale discounts, secondary discounts. And I wanted to mention the Santosh Distributors ruling, where they actually took a view that a post-sale price reduction that you make downstream effectively becomes a sort of subsidy that you give to your reseller, and therefore that it should be added back to his selling price. Now, this matter is currently pending before the Kerala High Court. We need to sort of wait to hear the last word on it. But again, discount schemes is something which one needs to look at very, very carefully. In terms of, keep in mind Circular 105, which of course got rescinded, but it raised the ugly proposition that you can actually deem a price reduction to be in lieu of services in clearly what is a trading context. So while you could be actually in a trading supply chain, seller to buyer turn seller, they actually took a view in Circular 105 before it got struck down that actually could be seen to have an element of service. Next slide, please. And I think that's our last slide. I'll wind it up quickly. Just in terms of a couple of other issues and a couple of points of safeguard. The ocean freight point is, of course, well known. The Mohit Minerals case is old. I just want to caution on two things. So several people have taken the quote-unquote safe view that let me pay the tax, even though I don't believe that the tax is payable by me as service recipient, because the ITC is available to me as an input service. The risk there is, and we've seen that happen in a couple of cases, that the department is seeking to take the view, notwithstanding that the DRI and some of its discussions with people have been saying, no, why don't you pay the tax and take the credit? There have actually been instances where another part of the department is saying actually that there's a potential risk to this ITC on the basis that you're not the service recipient and therefore you don't qualify under Section 16. I just want to touch upon IP arrangements very quickly. The difference again between IP and franchise, this was even more relevant prior to the rate change of IP services from 12 to 18%, because otherwise for a business model, this was a key question saying, am I operating under an IPR license or am I operating under a franchise? Because the tax that I would need to pay was very different. that is again fertile ground for litigation, which of course goes away now that the IPR has moved to the 18%, but a point to keep in mind. Sudipta talked about the issue of import of goods and brand. I wanted to mention the issue of the status of goods for sale of intangibles, especially in the context of the recent brand sale that we saw between two foreign, two multinationals, in terms of a brand which was being used in India. And the question in terms of where ownership of that brand resides. So unfortunately, while we've defined place of service provider and place of service recipient, we don't define place of goods provider and goods recipient, and therefore for these IP transactions, again, there's a little bit of a hanging sword there in terms of litigation that could arise. The next set of points deals with the TP transactions as well as the brand transactions deal with Schedule 1 situations where you're actually not paying consideration for a supply, but there is a risk there that the department is going to say that there is an underlying transaction which is being provided free of cost and that needs to be taxed. So the first of those is the brand name issue. That's already been an issue which has visited several of our clients who are actually operating under common brand name. So it's not a licensing of the nature that we had in the Tata case, which went up to the Bombay High Court and now to the Supreme Court. This is just a brand name where there is no consideration, but groups of or a group of entities associate themselves under a brand. There is a risk that that transaction is being seen as a Schedule 1 transaction. On the transfer pricing side, I just wanted to mention that all of you as multinationals would be undertaking the transfer pricing compliance, and keeping a sort of eye on that while you actually undertake your GST compliance is going to become very important. So several of the transactions that you might report for transfer pricing purposes may or perhaps may not trigger a GST consequence, but it's certainly something that you should keep in mind. And I want to talk maybe about corporate guarantee. I think that's a classic case, saying that if you have a corporate guarantee which is being provided by a foreign parent to its Indian subsidiary, and it's not being charged for, and because it's in lieu of the fact that otherwise, the loan, let's say that the Indian company is taking would have been funded by the foreign parent, then we do have transfer pricing precedent, and in fact, even the Indian Transfer Pricing Authority has accepted that that is not a taxable transaction where you need to deem it to be a transaction for transfer pricing purposes. But we don't have clarity, or we don't have a sound basis to be able to apply that same logic for GST purposes. So I just wanted to, mention that to you to say that do please keep a careful eye about how transfer pricing transactions are being reported with or without consideration, and do take a considered call in terms of whether you want to treat those as taxable transactions for GST. I think the last two are, ongoing issues in terms of the department trying to tax secondment costs, trying to treat liquidated damages. These are all sort of issues which we continue to grapple with. These are both old issues, but I just wanted to mention them both again because for a multi-MNC audience, these might be issues of day-to-day relevance. So I wind up with that slide. Mr. Lat, back to you. Thank you all again for being here with us this evening.
Thank you very much, Udayan and Sudipta. It has been a very enlightening session. I would like quickly hand over to Bhanubhai for his closing remarks.
Yeah, thank you both of you. Really, very much like enlightenment we got, and particularly where you pointed out there are many instances, cases which can lead to the arrest, and that's really now we need to be very careful there. Yes, apart from penalties can be somehow managed, but arrest is too much. And I know there are such some instances what you mentioned are very much useful to us, and we need to be careful there. Investigations you took, I think many cases where what the investigation can lead to again. So I think it was basically what I see, all administrative and issues which can, all the conflicts can lead to the court. And that is where we have to be very careful. Okay, many other points. Yes, the old outstandings, even particularly I saw this intermediary. That was really, even we are facing that problem even today. And reimbursement of expenses, that is another area. This corporate guarantees, and so these are like very lively cases, and good that you again pointed out. And so in case we come across such issues within our companies, we need to be careful, and we have to take the expert advice. Thank you very much. It was really a good session. And in spite of whatever limitation of time, I think you covered most of the points which are really very, you can say, important, and which could have otherwise caused issues, like if it was not known, they are not known to us. So thank you very much again. So that's all from my side, and again handing over back to Mr. Shiv Prasad.
So thank you, Mr. Bhanubai, for your opening and summarizing the whole session. And thanks once again, Sudipta and Udayan, and all of you for being present for this lively session today. Please stay tuned in for our next webinar on the 27th, which is on dividend taxation on dividends for Swiss companies. Have a nice evening, and goodbye.
Thank you.
Bye, everyone. Thank you.
Bye.